Live TV. Today's going to be an interesting episode. We're going to talk about risk and dangers to your finances mostly, but where does that come from? Can it come from your business risk for cyber attacks? Can it come from real estate? If you own real estate or if you don't own real estate, you may have risk. And also, there's maybe a hidden shadow event happening in the banking industry where there's right in plain sight, hidden in plain sight, money that's flying out of the banks that may not have anything to do with people worrying about risk of the banks. It may have to be a self-fulfilling prophecy where people are creating their own risk. So let's first take a look at the cyber risk that's out there. So if you have a business, or even if you're a private client or high net worth individual, you may want to be aware of the cyber risk that's out there. Here is the first known healthcare facility that actually had to close because of a ransomware attack. And this gets into a few details that we've talked about before, but it's important to see what the end result is. It took many months for this to happen. But here is a hospital that had a ransomware attack in 2021. It could be 2 years ago. And it halted the hospital's ability to submit claims to insurers. This is what we've been talking about with this cyber risk. If you're a business and you're hit with a cyber attack, you may not be able to collect on your accounts receivable. You may not be able to process orders. Maybe your sales orders goes through the web and that connects to your server. If the ransomware attack locks all that down, you're out of business. Cash flow is the lifeblood of a business. And if you don't have that cash flow coming in, or you can't collect your receivables, you're done, right? Think about risk in terms of what's replaceable. See in this picture of this hospital, there's a brick building and windows and whatnot. If the building was damaged, physically damaged, a building can be replaced. Now, in the case of a hospital, it may not be practical. There's a lot of very specific devices and equipment that's in there that might not fit in another type of building. But for the most part, structures and facilities are replaceable. You can rebuild a building. You can buy new equipment. You can relocate to another property. In fact, many companies relocate all the time, move from one office to another. So if there's physical damage to a building, it's going to create a hassle for that business, but that risk is quantifiable and it's fixable. There's other risks that are financial risk. If you get sued and you lose money, that's a one-time event. And that money can be replaceable through insurance, maybe through savings, or through borrowing to replace it. Cash can be replaced that way. There's other risks that have to do with liability, right? That you may have losses for liability, slip and fall, that kind of thing. That gets more to financial. But here's the thing. The cyber risk is insidious because if a business, in this case, a hospital, is hit by a ransomware attack, it takes away an asset of that business that is not replaceable. It is your basic functionality, your order processing, your accounts receivable, getting paid from insurance companies. Setting aside the fact that a hospital has a much higher, very risky scenario that patients' well-being could be put in jeopardy. That's a whole nother issue. Hopefully they have great doctors and great medical staff that can intervene and if the equipment is locked up, they can still handle that patient. But if your accounts receivable are not able to be collected, that could put you in a death spiral where you can't pay your payables and now you have additional credit requirements. Maybe your vendors put you on credit hold or require cash payments. Who knows? Now, they may be sympathetic to the fact that you had a cyber attack, but they have to have their cash too, right? For payroll, for rent, for utilities. So this type of cyber attack, like we said, is insidious to um, a business. It can actually threaten more than just the one-time event of that cyber attack. In this case, the hospital will shutter its doors because of a devastating cyber attack, which makes it the first hospital to publicly link criminal hackers to its closure. Right? Due to a number of factors, the pandemic, the cyber attack on the computer system become impossible to sustain our ministry. Right? Um, there were over 300 documented attacks on healthcare facilities in 2020. That was 3 years ago. I'm sure it's higher than that. This year's on pace to match that. This is a ripple effect. It will have a profound impact on the well-being of our community. So what could be done about cyber attacks? Well, here's an example of coverage. This is one company, Coalition, good company. And in addition to covering the typical losses, things like stolen funds, lost income, which is a big factor, the cost of responding to the breach, replacing computers, extortion costs, bodily injury. In addition to covering those, here's what's most important about these policies: active protection. All policyholders get free active monitoring and alerting to prevent issues before they arise. Active response. In-house expert claims respond so fast you can recover faster. So this is where most high quality or higher coverage cyber insurance policies are different from normal risk policies. They will try to prevent the attack. They will be on your system, just sitting there waiting to observe these hacks coming in. There's also a really big development in the legal world for cyber insurance. Cyber insurance victory for policyholders. There were some exclusions that were vague within policies that were allowing some insurance companies to avoid making payments. The appellate division ruled that a war exclusion did not bar coverage for losses from a cyber attack. So most policies have an exclusion of coverage for war or nuclear event, that kind of thing. And a lot of insurance companies were trying to apply that to a cyber attack because they said, well, these hackers are only out there because of a war. In this case, war between Russia and Ukraine. In this case, the denied claim went to the court and it was appealed. And the insurance industry said, no, this is an excluded policy. And they also claimed that the hack was part of the Kremlin's ongoing effort to destabilize Ukraine. Right? Many U.S. companies suffered collateral damage. But the court said those exclusions must be construed narrowly, and hostile or warlike actions need to involve more than ill will or desired harm. It needs to involve military action. So these hackers weren't part of the military. So fortunately, the insureds, the people who are covered, were able to get coverage and get paid. The implications are that most standalone policies have a war exclusion, but the cyber policies have to have a war or warlike actions or actions by a military force or invasion. So whatever policy you get, make sure you look to see what's excluded. Some of them are starting to expand the language to exclude cyber terrorism, which may bring this exclusion back in. It's important to know that if you are getting cyber insurance, you want to know what's covered or what's not. This court ruling helps policyholders quite a bit know what's covered. And look, maybe there's an option of different policies. Some cover this type of claim if it's a state-sponsored act, some don't. You might have to pay more to get the coverage, but if the higher probability is that a cyber attack is going to come from a government authority or a government adjacent or government sponsored, you might want to have that coverage in place. One of the things about cyber insurance that's really interesting is that when you have a claim, the event may have occurred 2 months prior. Sometimes these hackers go into your system, sit there, monitor, check your emails, get your passwords, collect everything they need to launch an attack. at a later date. So that's one thing about cyber insurance that's different from other types of events. Usually most events happen instantly: a fire, a slip and fall, building collapse, damage. Those happen in an event type scenario, where cyber attacks can happen over time. You may only notice it at the very end when the event shows up and all your computers are locked up, but usually it happens over time. Next, we're going to talk about housing. According to math and according to real estate experts, home buyers still need to make 138,000 a year to afford a $500,000 home. Why is that important? 500,000. Well, that's because that's around the median price of homes. Right now, you're finding that the median price for real estate is about 460 to 470. Many markets are much higher than that. So 500,000 is kind of the sweet spot of being able to find a decent house. In order to afford that house, you need to be at about a buck 40 in income. Um, Also, the existing houses that are out there that could be for sale, 98% of outstanding mortgages have a below market rate. What does that mean? What that means is that the people who are out there with existing homes that could sell them, 98% of them have a rate that's way lower than what it is today. Right now, you're talking about roughly 7% interest. So if somebody's out there that has a 3 or 4% interest rate and they want to sell their house, they also have to factor in that their new house they're going to buy is going to have a higher rate, because you can't keep your mortgage. You can't move your mortgage with you to the new house. You have to get a new mortgage. The buyer of your old house, they can't take over your mortgage either. There's a few exceptions. Some VA loans are assumable, but it's pretty rare, and it only assumes to the value of the mortgage. So equity has to be paid in cash. So for functional purposes, assumable mortgages are not really that practical to expect. So what that means is that the vast majority of potential resale inventory is locked up because these rates are so low that nobody in their right mind would ever sell their house unless they own it for cash with no mortgage, or unless they bought it within the last couple of years, or for whatever reason never refinanced when the rates were at 3%. Again, that's only 2% of the population. That's going to hold back inventory. So even if the prices being high and the rate being high is making buyers pause and slow down, that supply and demand equivalency is going to remain the same, because even though there's less aggressive buyers, there's also less sellers, fewer sellers, because they have these low rates. This is keeping the price high. Mortgage rates dropped a little bit, but you still have to have about $138,000 a year if you want to keep your housing expenses at 30% or less, which is what most lenders are going to be looking for. This is figuring on a rate of 6.69, roughly 6.7. Now, what's going to happen to rates? Well, the Fed already said they're probably not going to bump rates up at all in the next year or so. The rates may not go down, but they're probably not going to go up. But what happens after that? Well, it all depends on what happens with the economy. However, historically, a 10% interest rate is normal. For many years in the 80s, interest rates were in the teens, 17, 18. Sometimes they were 20%. A 10% mortgage rate, cap rate, is something that for a long time was very normal. So the rates could go up. In fact, the vast majority of modern history of mortgages, the rates were never below where they are now. Now, history doesn't always repeat itself, but there's a reason why 10% is a rough number. It includes all the factors: profit, risk, foreclosures, cost of the money. When the mortgage company comes up with capital to fund these mortgages, they also have to figure what's their cost of money. Many times they have to borrow it. And if the Fed is at 4 or 5%, that's where they have to be, the market up from there. Even if they have capital sitting in the bank, they have to look at it and say, well, wait a minute, I could just put this money into T-bills at 5% or CDs at 5 or 6%, whatever it is, and have no overhead, no processing, no mortgage servicing, no expenses, no risk of delinquency, and I just bank 5 or 6% all day long. Maybe that's better than charging 6 or 7% on a mortgage. Who knows? So the rates are going to affect what the consumers are seeing. How do you get houses to be more affordable? Well, obviously, this is oversimplified. The way you bring affordability back is to one of three ways: raise incomes, lower rates, or you lower home prices. Duh. It's so simple, right? But how do you do those things? Who's you? It says you either raise incomes. Who's you that's going to raise incomes, right? So this person who's being interviewed is a chief demographer at John Burns Research. He says, you bring back affordability by you raising income. Who are you pointing your finger at? Who's the you that's going to raise incomes? Of course, everybody would want to have higher incomes if they could. So who's going to do it? The employers could do it, but they have profitability, expenses. They have their own issues. If the economy is going to have a recession, and all of a sudden you raised incomes, now you might not be able to stay in business, right? What about you lower rates? Again, who are they pointing the finger at for you? I know it's hypothetical, but still you have to decide who's going to lower the rates. Well, all the rates originate from the Federal Reserve. And if the Federal Reserve is saying rates are going to be at 4 or 5%, whatever they have their standard rate at, all other rates emanate from that. And they have to fine tune and triangulate that rate to counter other things like inflation. If inflation gets too much, they have to raise the rate to cool off the economy. It's like a nuclear reactor. You have to put the control rods back into the system. So their hands are tied. They can't just magically lower rates to zero, because then you'll have more inflation and then it throws everything else out of whack. So there's a problem there. And it says you lower home prices. Well, who sets the home prices? Who do you think sets home prices? Well, it's a combination of buyer and seller, but in reality, it's all on the seller. The seller is the one that sets the price. They're the one who decides I'm selling it or not. The buyer can make any offer they want. They can offer $1 million, they can offer $1, they can offer anything. They don't set the price. The price is not set until the seller says, okay, I'll sell it. So even if every seller in the world, every single real estate seller, they all got together, every real estate buyer, every real estate buyer in the world, they all get together and they form a union of buyers, and they say, we're not paying more than $50,000 for any house. We are not going to outbid each other. We're going to stick our ground, and we're going to say we're not paying more than $50,000 for a house. Well, that's great. And if every buyer says that, that's unified power. But until the seller agrees to it, ain't no lower home prices. The seller has to agree to it. The buyer can have some influence. There are some sellers that have to sell, but until the bid gets to the point where it's worth selling, sellers aren't going to sell. So really, the seller is in the driver's seat. The seller is who decides. Now, you might think sometimes you've heard of a buyer's market, seller's market. That's true. A buyer's market just means that the buyers aren't willing to have the same appetite. But again, you can't force the seller to sell for a lower price unless they want to. And what makes them want to? Well, what's their other option? Most people that sell a house are selling it because they're going to move to another house. Sure, there are exceptions where somebody dies, maybe somebody gets divorced, they have to sell their house. But the vast majority of people who are selling a house have to move to another house. So they're going to look at their options. If they have to go rent somewhere and it's going to cost more money, why bother? If they're going to have to pay 8% versus the 3%, even if they downscale their house, you can't downscale enough to have the same payment. So sellers have to be on board with this. And that's going to be something that is tough to do. So those are your three options. Raise incomes. Is that going to happen? Lower rates, how's that going to happen? Or lower home prices. So if all of those three things are highly dubious, and those are the three things that will bring affordability back, and those aren't going to happen, what does that tell you? It tells you that affordability might not be back. Well, that's not true. A different type of affordability. Maybe going forward, houses are a higher expense compared to income. In the 1970s, stocks up until that point traded at what's called a price to earnings ratio, a PE ratio that was in the single digits. So the price of a stock was compared to what it had for profits or earnings, and there was a certain ratio between the two. Well, in the 80s into the 90s, that ratio jumped up. And the reason why is because there was more liquidity in the market. There was more appetite from retail investors. A few factors came in, and that PE ratio changed forever, permanently. The same could be holding true for real estate. The ratio of home prices versus income may now have crossed the Rubicon, may have changed permanently because of the fact that the inventory is low. People are more inclined to buy a house. People's mentalities have changed. So there may be factors that have changed forever. The not necessarily the price of a house, but the percentage of what the house is compared to income. This is something where you won't know until a few years have gone by. The other part of it is if you lower home prices, you could do that by building a ton of houses quickly. But building a house is not like even building a car or putting up a fence. It takes months or years for the land inventory to become platted out, permitted, subdivisions approved, floor plans put in place, construction started, right? That can take at least months. And really, it looks like it only takes a few months from the time they start digging and breaking ground until the time it's ready. But before that, there were months or years of other activity that went into that particular project. And some of the things that went into it were permits, there were design and lot prep work, there was grading, there was the financing of the project where you have to have a rolling line of credit to build each house. And then once you get a CO and it's approved, and you can have a closing, and maybe you can get more money to build the next house. That's why you see in a subdivision, there's always right on the edge of that building boundary. There's always 8 or 9 houses being built. There's all the finished ones behind it people have moved into. The other ones are empty lots, maybe with a foundation, maybe with some grading, but the building is occurring with a certain number of homes. And that number of homes really is the balance sheet capital of the builder. Some builders can have 20 homes in construction at a time, because once you start constructing a home, now you have the labor cost, the materials cost of that home. That clock is ticking on that line of credit or that cash. If it's an empty lot, you don't have money out there because you own the whole property. Once you sell it, now you don't have the money out there because you've cashed out of that one house. So if you're thin, you might only be able to have 3 or 4 houses in under construction at any given time. If you're a fat, deep pocket builder, you might have 8 or 10. If you're one of the national chains, Lennar, those kind of companies, you maybe can have 20 or 30 in a subdivision under construction. It also depends on the turn rate. How fast are you turning your houses? The problem is, even if you turn them faster, it still is a long process to build homes. And you also can't start and stop on a dime. If 2 years ago, it seemed like the real estate market was slowing down, a lot of builders put projects on mothballs. They put them on ice. They pulled permits. They stopped, getting equipment leased. You have to capitalize your equipment. They stopped retaining employees on staff, carpenters, framers, that kind of thing. And then once the market turns around, it takes a while to ramp up all those factors, all those resources. It's not like an ice cream stand. You need an extra person. You just hire somebody behind the counter for an ice cream stand. This is a bigger deal. So this is one of the reasons why the construction of homes ramp up takes a little bit longer. And one of the things we're going to talk about has to do with finances. This was a quietly released stat. $79 billion exited the banking system in 1 week as deposit flight resumes. Well, it sounds like a lot of money. It is a lot of money, but what about in comparison? If that's normal, then it doesn't mean anything. According to the newly updated stats, 76 billion exited the banking system from the start of the month through June 7th. So that's the first week in June. Is a big reversal after 2 weeks of inflows. And last year, the whole year, 803 billion was drained out. Right? So this is like 1/10 of that in a week. Depositors withdrew 47 billion, breaking a 39-year record that goes back to the first day FDIC began tracking. So that's the real news. This is a record going back almost 40 years of people taking money out of the bank. Now, why is that? That's another big question. What's the why behind it? Look, if there was a specific event, maybe a bank went out of business last week, or maybe there was some, rumblings in the market that banks are gonna, you're gonna lose your money, then I can understand the run on the bank. But other than the fact that a couple banks went bust earlier in the year, there's really no recent news that would make people want to take their money out, right? Anybody who's going to take their money out because of SVB or any of these other bank failures probably already did way before June. So why are they taking it out now? Well, it could be that the people actually need the money. Maybe it has nothing to do with the banks, has nothing to do with the banking system, has nothing to do with, any one event. It has to do with the fact that people need cash flow, right? Pulling large amounts of cash out means that maybe people need the cash. Maybe pandemic money's over, stimulus money's over, low interest rate is over, employment's starting to back down a little bit, inflation is up. Maybe now people are saying, wait a minute, I got money in the bank. I need to start taking some out. Maybe that's all there is to it. Over the next few weeks, we'll see what the trend is. It may be something where the money that was in the bank was artificially inflated because of low interest rates, lower prices of commodities like groceries and gasoline, and now people need that money. 472 billion, half a trillion out of their banks in a quarter. To the extent it's well distributed, the system could take the losses. Do not expect there will be losses, but there will be banks that have concentrations, and those banks will experience losses. We're monitoring it carefully. This is FDIC. It feels like something will be around for some time, right? So they're not thinking this is going to be over. Lenders with less than 250 billion account for 80% of the commercial real estate lending. So that's another side of it. Is this money goes into real estate lending, which means it's going to have to come out of real estate lending. With regard to finances, what are your thoughts? What are you seeing in your world? Are you, as a consumer, having to pull money out of your bank to cover bills? Do you have to reduce the amount in savings in your checking account? Even if it's a small amount, if you're a household that has, $20,000 in a bank account, over the last month, did you draw it down to 18,000 or 17,000? That may not seem like a lot, but when you add it up over millions of people, that could be the $80 billion that came out. All of this is related. This might be related to the real estate market, to the insurance risk. Personal finance is kind of the engine that drives all commerce, consumer appetite. And if that dries up, then who knows where the economy is going to go, where private enterprise is going to go.
Are you tired of automated systems and chatbots when you need assistance? Experience actualhuman.com and connect with real professionals, not automation. At actualhuman.com, we bring you a network of professionals who are excited to answer your questions and provide guidance. Getting started is easy. Let us show you how. Here's how it works. Step 1. Select the best date and time for your video call. Step 2. Describe your situation and the areas you're looking for advice. Step 3. Connect one-on-one with an expert and get the undivided attention that you deserve. Experience the difference. Visit actualhuman.com today